Chapter 3, Problem 3. This problem is labeled 314 in your text, and it asks us to compare and contrast gain versus margin. Margin, gross margin, is related to the business of your business. Gain is peripheral. It's when you buy or sell things profitably or lose money on them, but it's not part of your business. So if you're a car dealer and you sell your building, you could make $1 jillion on it. It's not revenue, therefore it doesn't count as margin. It's gain. So let's take a look at this. These are the balances it had at the beginning of the year. It had cash, inventory, land, stock, and retained earnings. Then they tell us they had these events. First event they tell us about is that they sold inventory that cost $22,000 for $40,500. Well, that, my friends, is the definition of gross margin. 40,000 minus, so we had 40,500 was our sales revenue. That's what we sold the stuff for. It cost us 22,000. The difference between those, 18,500, is our gross margin. So that's the first part. So unlike some of the earlier homework problems in this chapter that took like a day and a half, this is not quite so. The next one they talked to us about is they sold land that cost $30,000 for $46,000. Well, the difference between what the land cost us and what we sold it for is a gain, as long as we're not a real estate agent. It doesn't tell us that we are, we assume that we are not. So, the selling price of the land, I'm sitting at my own desk and I can't find a bloody pen. Selling price of the land, $46,000. The purchase price was $30,000. The gain on the sale of the land, $16,000. Then it asks us to do some thinking about this, and says comment on how the gross margin versus the gain would be shown on the income statement. Well, gross margin is the sales less the cost of goods sold, and that's shown on the income statement. The gain on the sale of land is a peripheral transaction. It's not part of the business of our business. So that necessarily would not be listed on the income statement. Okay? You'll see income statements and gain or loss is listed, but that's just a matter of convenience because there's no other place to list them. A company could list a separate sheet saying gain or loss on peripheral transactions and list it there. Traditionally, they put them on income statements, but it's simply a matter of convenience, nothing else. And next, comment on how these will be shown on the income on a statement of cash flows. Well, at this point, I'm hoping you're screaming at the camera or the screen saying, if it ain't cash, dummy, it ain't on there. So the gross margin or the gain wouldn't necessarily be shown on a statement of cash flows, only the piece of it that was in cash. So if they sold a piece of land or traded a piece of land for a building. That's maybe an important transaction. They could measure it accurately in dollars and cents, but there was no cash involved. And because there was no cash involved, it would not go on a statement of cash flows.